1,400 tons. That's how much gold central banks bought last year, the second highest total in history. Listen, if you're holding dollars and waiting for the Federal Reserve to save you, you're making the same mistake I see pension funds making right now. The gap between people who understand what's happening to currency and people who don't is about to become permanent. I'm Dalio. I've managed $124 billion through 4 debt crises. I predicted the 2008 collapse 18 months before Lehman failed. And I'm telling you right now, gold has already become the world's second reserve currency. Central banks know this. They're acting on it. You're not. In the next 12 minutes, I'm going to show you exactly why gold jumped from number 5 to number 2 in the global monetary hierarchy, what the 16 largest central banks are doing that they're not announcing publicly, and the 3-phase timeline you need to follow in the next 90 days. Let's start with what happened in May of last year. In 1982, I lost everything. I borrowed $4,000 from my father to keep Bridgewater alive. I had bet that the debt crisis would destroy the American economy. I was right about the crisis. I was catastrophically wrong about the outcome. Why? Because I didn't understand that the United States controlled the printing press. Mexico defaulted. Brazil defaulted. The dollar got stronger. That failure taught me the most important lesson of my career. Distinguish between countries that borrow in their own currency and countries that don't. That single distinction determines whether you get inflation or deflation, whether gold rises or falls, whether your purchasing power survives or gets destroyed. Fast forward 42 years, we're now in stage 7 of an 8-stage debt cycle. I've studied 500 years of these cycles across 22 empires. Stage 7 is where the dominant power starts losing reserve currency status, but still controls the printing press. That's where we are right now. And here's what nobody's telling you. Gold isn't rising because of inflation fears or geopolitical tension. Those are symptoms. Gold is rising because central banks have fundamentally changed how they view the dollar. They're not selling treasuries and buying gold as a hedge. They're replacing dollar reserves with gold reserves as a permanent reallocation. Look at the numbers. In 2010, central banks held $800 billion in gold reserves. Last year, $2.4 trillion. That's a 200% increase, while global GDP grew only 60%. This isn't portfolio rebalancing. This is a structural shift in what counts as money at the sovereign level. The Bank of International Settlements, the central bank of central banks, released data 6 months ago that everyone ignored. Gold now represents 18% of total global reserves. That puts it ahead of the euro, ahead of the yen, ahead of the pound. Only the dollar is bigger. Gold is officially the number 2 currency, and the gap is closing faster than any currency transition in modern history. Let me show you the 5-factor framework I developed to track reserve currency transitions. I built this after studying the British pound's collapse from 1914 to 1971. It took 57 years for the pound to fully lose reserve status, but the critical damage happened in 3 concentrated phases. We're in phase 2 right now. Factor 1, debt to GDP trajectory. When a reserve currency nation's debt to GDP exceeds 130%, foreign creditors start demanding higher interest rates. We crossed that threshold in 2021. We're now at 134%. Japan's higher, but Japan borrows in yen domestically. We borrow in dollars globally. Completely different dynamic. Factor 2, real interest rates relative to debt growth. If your debt is growing faster than your nominal interest rates, you're in a debt spiral. Our debt grew by $2.7 trillion last year. At 5% interest rates, that's $135 billion in annual interest just on the new debt. But real interest after inflation are only 2%. We're not paying down principal. We're not even covering real interest costs. We're diluting. Factor 3, trade settlement patterns. This is the factor Wall Street isn't tracking. In 2020, 87% of global trade invoices were in dollars. Last year, 79%. That's an 8-point drop in 4 years. It took the British pound 30 years to drop 8 points. We did it in 4. Why? Because China, Russia, India, Brazil, and Saudi Arabia are settling oil, lithium, and manufactured goods in yuan, gold-backed contracts, or barter arrangements. When trade settlement shifts, reserve demand follows within 18 to 36 months. Factor 4. Central bank buying patterns. Here's where it gets critical. From 1990 to 2008, central banks were net sellers of gold. They sold an average of 400 tons per year. They believed the barbarous relic narrative. Then 2008 happened. In 2010, they became net buyers, small amounts. 80 tons, 150 tons. Last year, 1,045 tons. Poland bought 130 tons. China bought 225 tons officially, probably double that through unreported channels. Singapore, India, Turkey, Czech Republic. Even the Philippines bought 30 tons. These aren't commodity trades. These are monetary architecture decisions. Factor 5. Sanctions weaponization. In February 2022, the US and EU froze $300 billion in Russian central bank reserves. That was the moment everything changed. Every central bank governor in the world asked the same question: can they do that to us? The answer is yes. Gold can't be frozen. It can't be sanctioned. It can't be diluted by another country's printing press. That's why Turkey moved 40% of its reserves into gold within 18 months. That's why China hasn't reported its full gold holdings since 1919. They don't want to telegraph the shift. Now here's the part that should terrify you. I ran a simulation with our team at Bridgewater. We modeled what happens when gold crosses 25% of global reserves. At that threshold, it becomes viable as a trade settlement layer between non-Western economies. We're at 18% now. The velocity from 18 to 25 is exponential, not linear, because it triggers network effects. Every additional country that adopts gold settlement makes it easier for the next country. We're 7 percentage points away from a phase transition, and at current central bank buying rates, we hit that threshold in 32 months, less than 3 years. So what do you do? I'm going to give you the exact 3-phase plan I'm recommending to institutional clients right now. This isn't theory. This is what sovereign wealth funds are executing today. Phase 1 is the next 90 days. Your goal is foundation positioning. Calculate your dollar exposure. If you're 100% in dollar-denominated assets, cash, treasury bonds, domestic stocks with no international revenue, you're unhedged against reserve currency transition. I'm not saying the dollar collapses tomorrow. I'm saying the probability of a 30 to 40% devaluation against hard assets over the next decade is above 60%. Those are terrible odds if you're holding 100% dollars. You need to move 10 to 15% of liquid net worth into gold. Not gold stocks, physical gold or allocated gold in jurisdictions with strong property rights. Switzerland, Singapore, jurisdictions with no capital controls and a history of neutrality. Here's the specific implementation. If you have 100,000 in liquid assets, that's 10 to 15,000 into gold. You can do this through allocated accounts with firms like Bullion Vault or Gold Money, where you own specific serialized bars stored in Zurich or Singapore vaults. Or you can buy physical 1-ounce coins, American Eagles, Canadian maple leaves, and store them in a safe deposit box or private vault. Do not use ETFs for your foundation position. GLD and IAU are fine for trading, but they're paper claims on gold, not gold itself. In a currency crisis, paper claims get restructured. Physical metal doesn't. Phase 2 is months 4 through 12. This is where you add asymmetric leverage, gold mining equities. I know what you're thinking. Ray, you just said physical only. Physical is your insurance. Equities are your upside capture. When gold moves from $2,600 an ounce to $4,000, and it will when we hit that 25% reserve threshold, senior miners like Newmont and Barrick will triple. Junior miners with undeveloped deposits will go 10 to 20 times. I'm not recommending you bet the farm on juniors, but 2 to 5% of your portfolio in a basket of 6 to 8 junior miners with proven reserves and strong balance sheets gives you convexity. If I'm wrong and gold stays flat, you lose 2 to 5%. If I'm right, that 2% becomes 20 to 40% of your portfolio value. The specific names I'm watching: Newmont, Barrick, Agnico Eagle for large cap stability. For mid-tiers with operational leverage, Alamos Gold, B2 Gold. For juniors with discovery potential, Rupert Resources, Osisko Mining.